Good evening, everybody. It's good morning from New York State. It's an early start for me. My name is Andrew Wilkinson. I'm the Director of Trading Education here at Interactive Brokers, and I am very pleased to have with me today from over in Singapore, Tariq Dennison.
Hong Kong.
Oh,
Yeah.
I apologize. I was just guessing there in my mind. Is it Singapore or is it Hong Kong? I'm going to go with Singapore. But from Hong Kong, we have Tariq Dennison of GFM Asset Management. He's going to be presenting today on an Asian currency strategy outlook for 2021 and beyond. Before I hand the microphone over to him, I just wanted to mention that this session is being recorded, and if you registered, you're going to receive a link to this event in your inbox within a couple of hours of the event ending, and that we have the slide deck in the GoToWebinar panel under the handouts panel. Click on that, expand it, and you can download today's slides from Tariq. If you have any questions, please enter them into the chat panel, and Tariq will be able to see those throughout the session, and we'll probably have a Q&A with me at the end, or he'll just handle the questions on his own. Tariq, over to you. Welcome. It's my first occasion presenting with you, so it's a huge welcome from me, and let's hear what you've got to show us and talk about today.
Thank you very much, Andrew. It's great to be back presenting what I believe is my first Interactive Brokers webinar for 2021, and I'm glad to be starting working with you, Andrew, and looking forward to many more educational webinars together. Today's topic, as Andrew mentioned, is Asian currencies, and I'm specifically going to be talking about 10 different Asian currencies and a fairly long-term history of them and a fairly long-run outlook on how to look at these 10 different currencies in 3 major groups. Now, before I begin, I have 3 important disclaimers. First, from Interactive Brokers. Next, we have our own disclaimer. Finally, a disclaimer from Singapore Exchange. Now, I think where Andrew may have been a little confused about my location is that I am presenting from the Hong Kong office of Singapore Exchange. I have been based here in Hong Kong for the past 11 years, but as you can probably guess from my accent, I am an American who started my career on Wall Street all the way back in the late 90s and early 2000s. And so right now I actually run 2 parallel independent wealth management practices, one based here in Hong Kong and the other one based in the US, very much serving that US-Asia corridor. I have 23 years in the markets, working both for a German bank in New York, London, and Frankfurt, Bear Stearns in New York, JP Morgan in New York, and then I moved out here with the Canadian Imperial Bank of Commerce, with whom I worked first in Toronto for a while, then in London for a while before coming out here. And then my last bank job was with Societe Generale here in Hong Kong. And then I started my own wealth management firm shortly after leaving SocGen. By background, I have a master's in financial engineering from the University of California at Berkeley, and I teach 2 courses, which I know I've left the acronym here, at ESSEC Business School in Singapore. So for the past several years, that would have meant flying down every single week to teach those courses. This year, they're online. Those 2 acronyms, FI and AA, mean fixed income and alternative assets. So I do teach about international bond markets as well as about hedge fund strategies, private equity, and cryptocurrencies. My focus is very much, as mentioned, on the US-Asia corridor, that is helping Asian residents invest in the US and helping US residents invest really across the different markets in Asia, and that includes developed markets such as Japan, Hong Kong, and Singapore, as well as looking at India, Vietnam, Indonesia, and many of the emerging markets out here. Many of these, again, are markets we'll be talking about in today's presentation on currencies. You may also see me as a regular media contributor on RTHK Radio 3's Money Talk, on the website Seeking Alpha, where I write many articles, and on the Asia Times Financial, where I recently wrote an article describing the updates to the Hang Seng Index. If you would like to read my book is titled Invest Outside the Box. It's 300 short pages trying to explain 11 main categories in investment. I wrote it to be a really English language, plain English guide to understanding different asset classes and strategies. Now, what am I going to be talking about today? I'm going to be talking about Asian currencies. And since it's a very, very big topic, Asia is obviously a very large continent where 60% of the world's population lives, very large percentage of the world's economic activities. I'm going to need to break today's presentation down into few big chunks, bite-sized chunks, but they're still going to be big chunks. First, I'm going to be describing three big groups of Asian currencies, of the 10 Asian currencies I'm going to be talking about. The first are what I call the big three: the Japanese yen, the Chinese yuan renminbi, and the Indian rupee. Next, I'm going to be talking about the three Asian tigers. Now, any of you who are my age and older will very much remember the Asian tigers theme from the 1990s. This referred to the four economies of South Korea, Taiwan, Hong Kong, and Singapore. I'll be able to talk about three of their currencies because the Hong Kong dollar is really too boring to mention, and there's really not much to trade or hedge there. And then finally, I'm going to be talking about four other Southeast Asian currencies that we often call the MTIP4. That is Malaysia, Thailand, Indonesia, and Philippines. Now, after I described the history and fundamentals of these 10 currencies, I then want to show you actionable strategies. I mean, this presentation is really mostly useful to you if we talk about what it is that you can actually do in your Interactive Brokers account. If you've got, let's say, a view on the Korean won, or if you want to hedge your Indian rupee exposure or earn Indian rupee interest rates, how do we do that? So I'm first of all going to give a quick 101 on how currency futures work, because first of all, I am providing a background on currencies. I'm not going to assume that all of you know how futures contracts work, but make sure that you know that they are a fairly standardized way to either hedge or gain currency exposure to one of these 10 currencies. I'm going to be describing strategies for hedging as well as for carry trades, that is earning higher interest rates and higher yielding currencies, momentum strategies, and examples of each of these strategies using currency futures. Now, I'm out here in Asia, and I know some of you are also here in Asia. Some of you attending this might be in Europe. Some of you might be really early birds on the US or Canadian East Coast. Now, those of you who may not be based in Asia and wonder what's the interest in Asian currencies, well, Asia is a very important economy, really has been historically and is expected to be in the future, in the future. I would say it's really only people of a certain age who might think of Asia's economy, Asia's share of the world economy, as relatively small compared to the whole world economy. When they thought of, let's say, the US economy or Europe's economy being, really the big show in town. But if you go back quite a long ways, if you go back to 1700 or 1800, more than half of the world's economy was in Asia, and that probably shouldn't surprise you. I mean, around that time, you had the Qing dynasty in China that was, still had, very, very large amounts of feudal wealth. India had not yet been colonized by the British, and you, of course, had the Mughal Empire with lots and lots of wealth there. You had many of the other, monarchies in different parts of Asia, some of which were certainly wealthier than others. And Europe was, still reaching out of the Renaissance. England was still fighting France, trying to bring Louis XIV to his knees. Clearly, if you were looking at which was the dominant power in the world, back in the middle part of the last millennium, you would have seen a lot of wealth in Asia. And just as we describe the, decline and fall of the Roman Empire, sometimes the decline and fall of the British Empire, we sometimes call about the fall and rise of China or the fall and rise of India, how these once very, very wealthy economies became relatively small parts of the world economy for a period of time, which now almost looks, like a dip. A dip happening right around World War II and kind of really peaking in the decades after World War II. But now, where we are right now, we're still only halfway back to where Asia's share of global economic activity was in the year 1700. So that is why this chart forecasts that by the year 2050, we'll be back in a world where half of the world's economy is in Asia. And so if you're looking at economic growth, you cannot really ignore Asian economies and these 10 Asian currencies that I'm going to be talking about today. What does it look like when we zoom in a little bit closer and use more official data? So in this case, data from the World Bank, where again, that top line is the one that most of you are probably most familiar with, the phenomenal growth of the US economy from 1960 until about now, from being a sub $1 trillion economy to almost a 20 trillion US dollar economy. What about all of the other, top 5 economies that I might be talking about? Well, those of you who've read my writing might know that I've often used the acronym JUICE, JUICE, to describe the world's 5 largest economies. And again, large economies and currencies by that measure. JUICE stands for Japan, US, India, China, and Eurozone. So those 5 currencies, if you just want to have 5 currencies, kind of on your hand, in front of you, they represent about 75% of the world's economic activity right now. And you can see that back in 1990, Japan was, of course, a much larger share of that. But for the past 30 years, Japan hasn't really gone anywhere. The real standout in this chart is, of course, China. If you go back to even the mid-1980s, China was the poorest of all of these what are now top 5 economies. In fact, many of you probably might not have seen it as a top 10 economy. But now China is solidly the world's second largest economy by nominal GDP terms, and in fact larger than the US by purchasing power parity terms. And we can look at a similar trajectory for India, although by official exchange rate, India is really only about as large as the UK or France right now. We're going to be waiting a few more years before India becomes much, much larger than any European country by comparison. Now, where it perhaps gets a little more dramatic is when we talk about on a per capita basis. You may say, okay, yeah, it's great that India and China are finally becoming, wealthier than European countries, but they also have a lot more people. And this is where, of course, we look at the trajectory of Japan, but, having been an emerging market all the way back in the 1940s and 50s, right after World War II, and then quickly going through the middle income track to becoming a high income country, really for most of our lifetime. So pretty much by the 1980s, Japan was already a wealthy high income country. And, even today is one of the most developed advanced economies in the world. But China and India are still much poorer than the developed markets on a per capita basis. They are, however, rising even on a per capita basis. One of the main reasons for this, of course, is China's population growth is slowing. India's population is still relatively young and still relatively quickly growing. But as you will see, China's per capita GDP surpassed India's back in the early 1990s, is now more than twice that of India's, and we'll have to see over the next few decades when China might catch up with Japan, perhaps even the US one day, and whether India might even catch up on a per capita basis. In terms of currencies, this is from the Bank of International Settlements and shows you what are the most traded currencies in the world. Now, perhaps not surprising, the big 3, the G3, if you want to call them, are the dollar, the euro, and the yen, the US dollar, the euro, and the Japanese yen. These together account for really most of the world's currency turnover, followed by the British pound, the Australian dollar, the Canadian dollar, and the Swiss franc. But the renminbi, if you'll notice, back in 2001, 2004 was nothing. Didn't even really rank anywhere on this table. By 2016, the Chinese Yuan Renminbi, despite being a closed current account, is now the 8th most heavily traded currency in the world. And we're going to be going into the renminbi in more detail later. So, besides talking about the world G3, I said that we were going to talk about 3 main groups of Asian currencies. And the first group here is what I call Asia's big 3. And these are the big 3 because they were included in the juice basket. They were Japan, India, and China. So let's take a look at what these 3 currencies are. I'm going to start with the yen because it's the most developed. It is the easiest one for you to trade and hold positions in your Interactive Brokers account. You can log in and buy some yen right now. You can buy some Japanese stocks. You can trade futures contracts denominated in yen, ETFs denominated in yen. It is a G3, global currency by every measure. It may not be viewed, for many as investment purposes because it is in Japan. Many people may not look to buy yen unless they're looking to either retire in Japan, go start a business in Japan. But it has a very fascinating history and is one of the currencies I describe as an appreciator, meaning that over long periods of time, it is generally strengthened against the US dollar. Well, what's the background on this? At the end of World War II, after Japan was defeated, after they surrendered to the Allies, Japan was occupied by the US military for a while, and in its reconstruction period, the new Japanese yen was redenominated, was fixed at an exchange rate of 360 Japanese yen to the US dollar. Why 360? Well, it came after the Japanese flag, which has a circle on it, 360 degrees, where the land of the rising sun. And it was at 360 to the dollar until 1971. What happened in 1971? On August 15th, Richard Nixon removed the US dollar from the gold standard, and by consequence, all the other currencies that were pegged to the dollar via gold were start to freely float as well. Now, for some currencies, like the pound sterling, for example, that led to a period of decline. The pound, as you might remember, for many, many years was at 2.8, 2.6, and had declined over many, many decades to around 1.3 today. The yen, on the other hand, has done the exact opposite. Why is that? Well, Japan, first of all, has experienced great amounts of economic growth and had huge trade surpluses for decades. For decades, Japan went from making relatively cheap knockoff goods to making much, much higher quality goods. In the 1980s, I don't know anyone who bought an American-made television anymore. Everyone bought Sony televisions. Toyota was competing head-on with General Motors. There were authors who thought the future of industry and manufacturing was going to be made in Japan. And with those trade surpluses, the Japanese saved a lot, they invested a lot. And the only way that the BOJ, the Bank of Japan, was able to cool down Japan's economy was by raising interest rates and tightening monetary policy. And that led to strengthening of the yen from 360 to around 100 today. So this is roughly a fourfold appreciation from 1971 to 1995. And it's been roughly range bound since then. So since 1995, the Japanese yen is mostly traded between around 80 to 130 to the dollar. So compared to many of the other currencies that I'm going to be describing, you could think of the yen as almost a safe haven currency. When, let's say, stock markets crash, when emerging market and high yield assets crash, the yen tends to go up rather than down. And the reason is why? Japanese, largely in search of higher yields, have invested overseas. Whenever markets sell off, when Japanese investors sell off, they sell off and they bring that money back into yen. That tends to push the yen up against other currencies. So that's why you call it a flight to quality, a risk-off asset. And again, that's due to the surpluses that have led Japanese to own many, many overseas investors. The factors to watch when trying to come up with your position on the yen is watch the overall levels of fiscal debt, because despite the trade surpluses, Japan has one of the highest debt to GDP ratios in the world. That is one of the reasons the BOJ has run a negative interest rate policy, what is called NIRP. That is partly because there are lots of Japanese savings sloshing around and people are willing to accept low interest rates, but also because if interest rates were higher, the Japanese government would run into real troubles paying off its debt. So those are macroeconomic factors to look at when coming up with your yen position. Next, I'm going to talk about the next giant economy in the Asia region, which is China. Now, for most of my childhood, no one ever thought about trading the renminbi. China wasn't really an economy that we looked at. And the transformation that China has undergone in my lifetime is nothing short of miraculous. Pre-1994, now we really need to almost think of the Chinese yuan currency in almost two different eras. Before 1994 was almost a completely different era than since 1994. Before 1994, it was before China was really an open market. The market was still very heavily controlled. There really was no such thing as a Chinese stock market. There were really gradual liberalizations for China to open up to foreign investment. And all of this, like many other places, happens in stages. In 2001, China joined the World Trade Organization. And that was really what set off the made in China decades that we've seen both in the 2000s and in the 2010s. And that really led to enormous trade surpluses, where China now holds over $1 trillion in US treasuries as foreign currency reserves. That allows it to manage a peg much better than some of the Southeast Asian currencies that we're going to talk about later. So if you want to ask, well, what is the difference between the renminbi and the yen? The renminbi is much more tightly managed as a managed float. From 1994 until 2005, it was actually just pegged to the US dollar at about 8.03 to the US dollar. Since then, it's been allowed to float, and for a period, it was appreciating against the dollar. Since then, it's been trading in a range, and really the range against the dollar has been more tied to what is called the SDR, the IMF special drawing rights. Just like the Singapore dollar that we're going to talk about later, the renminbi is really just trying to manage its currency so that it supports trade. Ultimately, the PBOC's goal is they want a renminbi exchange rate that is going to help Chinese exporters and ultimately help the Chinese economy. So that's really the thing to watch from a China economy and PBOC policy point of view. But the other thing to watch from an investor point of view is Bond Connect and the overall internationalization of the renminbi. Why do we not talk so much about Bond Connect? Well, because even though China now has the world's second largest bond market, foreign ownership of Chinese bonds is still less than 2%. So we have a lot of work to do as Interactive Brokers account holders to start owning larger and larger shares of the Chinese bond market and make it a part of the overall global currency portfolio that it seems to aspire to be. Third of the big three is the Indian rupee. And this is a currency I get asked about quite a lot because many clients I work with have Indian rupees. They have assets or other positions in India, and it's a currency which, unlike the yen, has largely devalued for most of the period that it's been allowed to free float. Since 1980, we've really seen the Indian rupee go from roughly 8 to the dollar to roughly 80 to the dollar. So roughly a 90% devaluation, if you want to consider. And I really describe this as what you call a classic emerging market devaluation. Now, yes, there are periods where the rupee is relatively stable. So, for much of the 2000s, for example, the rupee even strengthened from almost 50 to less than 40. But over long periods of time, the Indian rupee has largely devalued. Well, why is that? Well, one is that allowing the currency to weaken is considered to be good for Indian exporters. It also goes hand in hand with the fact that India has relatively high inflation, relatively high interest rates, a relatively young population. All of those things are somewhat related to each other, if you've heard my other talks on demographics and interest rates. But if you want to talk about economic liberalization and where does that fit with the diagram here, if you look at the currency chart, it will seem that devaluation really accelerated in 1991. What happened in 1991? India started liberalizing its economy. I would think of days when people would say sign up and register for something called a Godrej cupboard, or there were other kind of Indian white goods that were much more tightly controlled. And when India became more of a free market, that's where currency devaluation became one of the tools in the Reserve Bank of India's toolkit for keeping India's exports competitive. So you may say, okay, well, how has this policy worked? Unlike India, if you look at India's trade balance, most of the past 10 years, India's actually run trade deficits rather than trade surpluses. So in many ways, you can almost see this as a headwind to its currency. So what do you want to see in terms of coming up with a strategy for the rupee? Will the rupee be going to 100 in the next few years? Well, watch demographics. Look at the Indian economy. Look at capital flows. So the flows of imports and exports. But really, the main driver to watch out for, I would say, is real interest rates. So that's interest rates above the rate of inflation. If inflation remains high, that will drive more currency devaluation. That if inflation comes under control and the high interest rates become real interest rates, that would mean India is one of the few markets with positive real interest rates that could attract capital from overseas. So in terms of the G3, that's why India is worth watching. India and China in many ways can be thought of as having similar levels of currency control. Neither the renminbi nor the rupee are fully freely convertible. They're not, super easy to, put money, into or out of. But in terms of long-term depreciators, the next group I'm going to be talking about are the tigers. And here what I want to compare is I want to compare India not to China, but I want to compare India to Korea. The Korean won, despite the fact that Korea is considered a much more advanced economy, the Korean won is also not freely convertible. You may know, for example, in your Interactive Brokers, you can't just go freely buy Korean stocks. You can trade Korean futures contracts, and it'll settle in Korean won, and then you can only settle that Korean won position to close out whatever P&L that you might have in your Korean futures contracts. So even with different levels of development, the Indian rupee and the Korean won have more in common than you might think. But their demographics almost couldn't be more different. On the left, we have India's population pyramid, which shows it's a very young population. India's population is still growing, although it is expected to taper off really sometime later this century, say around the year 2060, 2070. And believe it or not, by the end of this century, India's population might be expected to decline. You'll have to make some assumptions there. Korea's population, by contrast, should almost scare you when you look at this population pyramid on the right. What do I mean by a scary population pyramid? Well, first of all, you'll notice how there are more 55, more people between the ages of 50 and 60 than there are kids under the age of 10. That's not a recipe for strong economic growth going forward. And in fact, if you look at the bottom half of that, Korea's population is expected to decline from over 50 million today to less than 30 million by the end of the century. Again, if you're looking at it from a point of view of economic growth and the future of a country's demographics, that will give you very, very different drivers for the Korean won than for the Indian rupee. So talking about the Korean won, let's look at this next group of currencies I've talked about, which are the East Asian tigers. If you saw my promotional video, you'll notice that I was wearing my tiger mask today because I wouldn't be caught outside with just a plain old blue mask. I need to have a nice design. But the tigers, the East Asian tigers, is a term that was coined in 1993 in a World Bank report describing the 4 Asian economies whose growth was expected to catch up with that of Japan's in the 70s and 80s. These were the economies of South Korea, Taiwan, Hong Kong, and Singapore. Now, of these 4, I'm not going to talk about the Hong Kong dollar because the Hong Kong dollar has been pegged to the US dollar since 1983. So, of course, there are no futures contracts on it, nothing to talk about. But the other 3 all have interesting currency stories I hope to excite you about here. First of all, the South Korean won, as I mentioned, could almost look a little bit like the Indian rupee as a long-term classic devaluation story. The big difference is that there were 2 big crash scenarios, 2 big risk-off scenarios where it wasn't just a gradual decline, but you actually saw a huge decline in, let's say, in 1997 from it was around 750, so less than 800 Korean won to the dollar, to over 1600 won to the dollar. The won then appreciated. It came back to less than 1,000 won to the dollar right before the global financial crisis, where again it crashed to around 1,500 won to the dollar. And it's actually been relatively stable since it recovered to less than 1,200 won to the dollar after the global financial crisis. So long term, it almost looks like an emerging market devaluation story. Then, in the late 90s and 2000s, it looked like a kind of a risk-off crash story. Now it almost looks like kind of a range-bound currency, like maybe the euro or the sterling in some ways. So even though it's restricted, some might argue it's looking more and more like a developed market currency. That's what I mean by DM-like. So the things to look out for to say, how am I going to have a view on the Korean won now? Well, you're going to watch trade balances. Is Korea running surpluses or deficits? What are the levels of domestic savings of Korean savers? How much are they saving in pensions and other products? And how is that driving yields in Korean treasury bonds, in KTBs, versus US treasuries? That swap between Korean interest rates and US interest rates is a very, very actively traded one. And that will tell you also, just like with the Indian rupee, real Korean interest rates will drive flows into the won. Negative real interest rates will drive flows out of the won. Next, we'll talk about what's called the new Taiwan dollar. Now, technically, the term is new Taiwan dollar because it replaced the old Taiwan dollar back in 1949 at a rate of 40,000 old Taiwan dollars to 1 new Taiwan dollar. Now, that was before I was born, so the only Taiwan dollar I've ever used, they're all new Taiwan dollars, but you still, when you arrive in Taipei, see NTD. And the story that I don't see here, I got these exchange rates from the Bank of International Settlements. They only gave me the exchange rates going from 1981, but from the 1950s to the 1960s, you saw a decline, so a classic emerging market devaluation from roughly 10 Taiwan dollars to the US dollar to 40 Taiwan dollars to the US dollar. Now, since then, the Taiwan dollar has been almost an appreciator, a relatively stable currency, or even relatively strong. Some might have even considered kind of like the yen in disguise from the late 1980s when the yen was strengthening as well. But really, since then, it hasn't really followed the yen quite so much in lockstep. There have been those who try to say I can use it as a proxy for the renminbi, but I'll let you chart it. I don't really think the Taiwan dollar and the renminbi really can be used that way. How else might you consider it more like the yen than like the renminbi? Well, Taiwan interest rates are very, very low. The 10-year bond yield in Taiwan is 0.35%, which is lower than in the US and really closer to what you'd see in Japan and Europe than you would see in almost any other market, developed or emerging. So it's the second lowest of the interest rate of the 10 currencies I'm going to be talking about here. And also, you have an aging population. You've got a lot of the demographic problems that you see in Japan and Korea. But the big thing to note about Taiwan is its insurance market. The Taiwanese insurance companies are some of the biggest buyers of long-dated US bonds and swapping them back into Taiwan dollars, and that drives the Taiwan dollar as well as the long end of the US bond market even in some cases. There are some really interesting stories on how Taiwanese life insurers drive that, and I encourage you to read up on it or ask me if you have questions on it. Third in the tigers, I want to talk about what is probably my favorite tiger currency, and that is the Singapore dollar. Now, of the three tigers, this is the one that you can most easily convert funds into in an Interactive Brokers account, and you can buy Singapore listed shares, Singapore ETFs, and trade futures contracts denominated in Singapore dollars. Not many people know or appreciate this, but the Singapore dollar is a managed currency board system. So it's effectively pegged, but it's pegged to a basket of currencies that is technically kept secret, although I often give it to my graduate students an exercise to figure out what that currency basket probably is. Basically, think of it as a trade-weighted basket of all of Singapore's trading partners, almost with the goal of trying to minimize how much the Singapore dollar moves against any major trading partner, with the goal of making it a relatively stable currency for anyone trading with Singapore. Currency board means the Monetary Authority of Singapore has that full currency basket held in reserve against every Singapore dollar outstanding. So in other words, unlike, let's say, the Thai baht in the 1990s, you cannot force the Singapore dollar to crash. If you go and try to redeem every single Singapore dollar, the Monetary Authority of Singapore will simply give you all of its reserves until there are no more Singapore dollars left. And that may not be quite the George Soros trade that you were looking, but that's why you cannot force the Singapore dollar to crash, or the Hong Kong dollar for that matter. Hong Kong dollar is also a currency board system, the same way that George Soros forced the Thai baht to crash when we talk about the Thai baht. The Monetary Authority of Singapore also uses the exchange rate as a monetary policy tool. So if you think of the Federal Reserve, when it wants to, tighten, monetary policy, rein in the economy, prevent inflation, it raises interest rates. What does the MAS do when it wants to control inflation in Singapore? It lets the Singapore dollar appreciate. And the same thing too, if it wants to loosen monetary policy to, stimulate the Singapore economy, it'll let the Singapore dollar weaken. But overall, the strengthening of the Singapore dollar has been, first of all, a sign of the strong Singapore economy, but also why I use it as a good proxy for a stable long-term currency, whether the dollar or euro goes down. You can basically think of it as a proxy for the SDR, which again, you can't buy SDRs in your Interactive Brokers account. I do recommend you looking them up if you're interested. So really, the only factor to look at in the Singapore dollar right now is how are other currencies doing. Look at a basket of the G3 currencies of dollar, euro, yen, and think of the Singapore dollar as a proxy of that. How do the economy sizes of Singapore and Korea compare with these next economies I'm going to talk about, which are the MTIP economies, the Southeast Asian economies? Well, all of them have had, fairly good levels of economic growth, but there are some things that you'll probably notice if you look at this chart in a little more detail. One is if you go back to the 1970s, perhaps not surprisingly, Indonesia's economy was larger than that of Korea's. In fact, Korea was almost kind of average, in this list if you go back to the 1960s. So Korea has seen much stronger economic growth and now has an economy twice the size of Indonesia's, despite the fact of having only a quarter of Indonesia's population. So that's something that you will definitely feel on the ground in the streets of Seoul versus in the streets of Jakarta. Thailand also would be another one where you could kind of say, well, wait a minute. I saw Korea's economy has done so well, and the Korean won is devalued, but the Thai baht is a relatively stable currency. It really hasn't moved much, but Thailand's economy hasn't done quite so well by comparison. That's one of the great questions I get, from these webinars, and I'm very happy to talk about why that is. One real standout here, of course, is Singapore. You'll notice that the smallest economy by far back in 1960 was that of Singapore, which makes sense. There were less than 2 million people on the tiny island of Singapore at the time. And now Singapore's economy is larger than that of Malaysia and the Philippines. Philippines has over 100 million people. Malaysia has about 30 million people, so many times the population of Singapore. So that's why I think it's important. You'd have to convert this to a per capita basis to kind of get an idea of how it feels rather than just overall size of the economy. But of the economies I'm going to be talking about, of course, Indonesia's is a very large economy, and that won't tell you very much about how the currencies are doing. So the lesson here is economic growth alone will not tell you if a currency will rise or fall. That's the lesson in this chart and the next charts. The tagline to that is Milton Friedman says inflation is always and everywhere a monetary phenomenon. What does that mean? Well, what it means is that whether a currency goes up or down doesn't have to do so much with how much stuff an economy produces. It has to do with how much money is there chasing it. So in Korea's case, the Bank of Korea was happy creating a lot more Korean won than Korea was producing more stuff. Even though Korea kept producing more stuff, the Bank of Korea produced won even faster. By contrast, Thailand may not have been quite as fast as producing more stuff, but the Bank of Thailand was much more restrained at producing more baht, making sure that it did not produce baht at a faster rate than Thailand was producing stuff. That kept inflation in Thailand low, and it kept the baht relatively strong compared with the Korean won. So that, in a nutshell, is the inflation argument for why some currencies are stronger than others. So now let's talk about the final group of 4 currencies, the MTIP group. MTIP, again, here is an acronym for Malaysia, Thailand, Indonesia, and the Philippines. First, I'm going to talk about the Thai baht. So even though it's not the first alphabetically, I'm going to talk about it because it's a relatively stable currency of all of the, what you might even consider emerging market currencies here. If you go all the way back to 1957, versus all the way up to 2020, it looks like a relative stable currency. In fact, the only outlier, the only time really you would have seen significant devaluation was in 1997. And this is the famous George Soros trade, where after George Soros broke the Bank of England, he broke the Bank of Thailand. He basically calculated what amount of dollar reserves did the Bank of Thailand have in order to maintain the peg of 25 Thai baht to the dollar. And he said, well, that's not enough to cover all the Thai baht in circulation. So I'm going to borrow Thai baht. I'm going to sell all the Thai baht I can get to the Bank of Thailand until it runs out of reserves. And when the Bank of Thailand runs out of reserves, it can no longer prop up the peg, and the Thai baht will collapse. And he was able to make an enormous amount of money on that short. That is basically how you collapse a central bank for fun and profit. Now, clearly, that wasn't very fun for Southeast Asia and the ensuing Asian financial crisis that followed. And the lesson learned from that is that the Southeast Asian central banks now have a much heftier reserves and much tighter controls over their reserves to prevent a speculative attack like that happening again. So other than that, the Thai baht has been a relatively stable currency. Well worth looking at, and in fact, it's looked at as a safe haven in Asia by many comparisons. Much of this, again, has to do with how the Bank of Thailand is much more restrained in printing new Thai baht compared with other emerging market banks in being looser with inflationary monetary policy. So the main thing to watch is the real interest rate differential versus the rest of ASEAN and whether that is going to sustain strong Thai baht exchange rates. I did manage, in looking for this presentation, found an interesting paper dated back to 1995. Looking at the comparative economies of Thailand versus Korea. I won't go through the whole thing, but you'll see the chart here that through the 1950s and 60s, per capita GDP in Korea and Thailand were about the same. But then it was really in the late 1960s, so from late 1960s to the early 1990s, Korean per capita GDP soared to well over 3 times that, to almost 4 times that of Thailand's. And you will feel this difference in the streets of Seoul versus streets of Busan versus the streets of Bangkok. But that's the real economy. That's physical goods and services. It does not tell you how many won are circulating versus how many baht are circulating. And that's what will tell you exchange rates. Next is the Malaysian Ringgit. Now, I get all sorts of opinions on the Malaysian Ringgit. Also can be seen as a relatively stable currency, although for the past 40 years, you could argue that there's been a trend of devaluation, the big bit of which, of course, happened in the 1997 crash. From the late 1990s until the early 2000s, you'll notice that a peg was once again reestablished, and the appreciation happening starting in 2005 really was almost meant to track the renminbi. There actually were traders I spoke to who viewed the Malaysian ringgit as a proxy for the renminbi from 2000 to 2010. But after 2010, that clearly was no longer the case. I mean, we always used to think of the ringgit as kind of being a three handle, like somewhere between 3 and 3.5. Now we think of it as having a four handle. So despite the fact that Malaysia has the highest credit rating of any Southeast Asian economy outside of Singapore, its currency management has been, I would say, quite different. In many ways, a lot more like that of Korea or like that of India, rather than that of, say, Thailand or Singapore. The real drivers to watch are, policy, that of the Bank Negara, and what are they going to do, really more than anything in response to oil prices. If you look at the devaluation since 2014, that was in response to a crash in oil prices. As you might know, the two twin towers in Kuala Lumpur, those are Petronas, the National Petroleum Company of Malaysia. That gives you a sign of how important oil and natural resources are to the Malaysian economy. Next, we have the Philippine peso. The Philippine peso has a little bit of an interesting history because, as you may know, the Philippines was in America, after being a Spanish colony for a while, was one of the few major overseas colonies of the United States, all the way up until independence in 1946. At independence in 1946, the Philippine peso was pegged at 12.9 grains of 90% gold, so a little bit obscure there, but based on the US gold standard at the time, that meant that one Philippine peso was equal to 50 US cents. So in other words, 2 Philippine pesos to 1 US dollar. And that peg lasted from 1946 to 1960. Ever since 1960, the Philippine peso has been a classic emerging market devaluation story, going from 2 pesos to the dollar to around 50 pesos to the dollar today. We've also seen a significant decline in Philippine interest rates. I remember in the late 1990s, Philippine interest rates were very high. We're in the low double digits, and we also saw this in the US dollar sovereign bond yields as well. The trend that we've seen over the past 20 years has we've been seeing a decline in Philippine interest rates, and that's come along with a strengthening in Philippine pesos during pro-cyclical periods and a weakening of the Philippine peso in kind of off-cycle periods. A main driver of anything having to do with Philippines account, you cannot ignore the term OFW, which stands for Overseas Filipino Worker. The Philippines has a lot of its citizens going and working overseas in all sorts of different jobs and sending home remittances, and those in a typical year will be 10% of the Philippines' GDP. That is one of the reasons why Philippine banks have some of the highest Capital One ratios, Tier 1 capital ratios on the planet. Simply because all of those flows come back, and the banks are very, very well capitalized. Again, though, whether or not the Philippine peso appreciates or depreciates has everything to do with the BSP, the Banco Central, deciding whether or not it wants to print more pesos or not to stimulate the economy. Last of all, so of all the 10 currencies I'm going to discuss, is the Indonesian Rupia. And why do I make it last? Well, it's a very high denomination note. It's also one that had the most spectacular decline in 1997. So you might remember the Korean won fell 50%. You might remember the Thai baht went from 25 to over 40. The Indonesian Rupia was pegged at roughly 2,500 to the dollar and went to over 14,000 in the 1997 crash. You might have remembered also the riots that happened in Indonesia, the fall of Suharto. It was a fairly chaotic time in Indonesia in the late 1990s after the Indonesian financial crisis. But actually since then, so especially in the 2010s, it's been viewed as the Brazil of the East. It's been viewed as an economy that has a very young population that is really ripe for a lot of e-commerce innovation, is one where there's certainly a lot of potential for economic growth, both from natural resources and also other types of, I would say, technology that you see in both India and Philippines by comparison. In terms of the currency, Indonesia has some of the highest interest rates of all the currencies that we've mentioned, and so as a result, it tends to draw risk trades. It tends to draw carry trades. Those that want to buy Indonesian Rupia to earn that higher yield are basically betting that it's not going to decline when they hold on to it. So when it's risk off, it means you sell the Indonesian Rupia and it falls. When it's risk on, it means people will buy the Indonesian Rupia and drive it up in chasing of higher yields. That is why actually compared with all the other currencies, I almost view the Indonesian Rupia, the best proxy is the VIX, the fear indicator, the volatility index, more than almost any other monetary policy tool. These two charts are from Asian Bonds Online, which is a website I highly recommend if you're interested in comparing these. These will show you the 10-year local currency bond yields in many of these currencies that I've presented. I will leave this here for your comparison. Now let's go ahead into actionable strategies. Let's talk about what are the trades you can actually put on to hedge or make money from your views in some of these currencies. Now, of all of these different currencies, there are several that have currency futures listed on SGX, but not all of them are terribly liquid. So I'm really going to highlight the 4 which I'm going to be able to pull up in my interactive brokers screen and show you sample trades on in interactive brokers on the Singapore Exchange futures contracts. These are the symbols for them on my interactive broker screen. You'll notice all the way up at the top, you have UJ and UY, which are the two for the yen of 2 different sizes. Then you have UC, which is for the Renminbi, and we'll see that that's quoted in a different convention than the other Renminbi one. IU is for the Indian Rupee, KU is for the Korean Won, and US is actually for the Singapore dollar, but it's a futures contract to buy US dollars priced in Singapore dollars. You'll also notice the volume tickers on the side. The biggest ones by far are the ones for China, India, and Korea, followed very distantly by those for Singapore. There are other exchanges where you might go to be trading the yen, which is why I'll be talking about these liquid 3 more than the others. If you go to SGX's website, you can get an example here of what a futures contract might look like, in this case on the Indian Rupee. I have gone to show only the T trading sessions because I want to show what the difference in price is between 2 successive months contracts. You will notice that if I look at the February contract, the March contract, and the April contract, that the contracts are getting cheaper and cheaper every month. So in other words, I can buy April now at 136 versus say 137.5 for February. Why is that? Well, some might say this represents an expectation that the Indian Rupee is going down, but really more than anything, it represents the fact that Indian interest rates are higher. And if you buy, let's say, April Indian Rupee futures, that is your way of earning the higher interest rate. It is reflected to you in a cheaper price for buying Indian rupees in the future. How can we visualize that, or how can we do the math on that? Well, this slide shows you how these 2 prices could be described. So we have imagine we have a front month price of 135 and a second month price. So let's say front month is February, second month is March, 135 and 134. How do we match these 2 up, and how do we see what the implied interest rate is? Well, the notional value of the contract is 2 million rupees, or 20 lakh rupees if you prefer calling it that way. And that's equivalent at an exchange rate of 135 to 27,000 US dollars. If I have 27,000 US dollars and I put it in the bank, right now, banks are paying nothing on my dollars. So in 1 month, I'm going to have $27,000. On the other hand, if I have 2 million rupees and I can earn, say, 8% interest on that, well, in 1 month, my 2 million rupees is going to be 2,014,925 rupees. And now, if I'm going to say that those are going to be equivalent, again, 1 month from now, the exchange rate of those 2 is at 134. So that's what's called a forward exchange rate. And you see it reflected in futures exchange rates. What that represents more than anything else is a difference in the interest rates between the 2 currencies. So if you don't have rupees in India, if you're sitting in Singapore or Dubai or Hong Kong and you want to buy, you want to earn those high rupee interest rates without, getting an Aadhaar card and moving money in rupees and all that, you can just buy the futures contracts and you're going to realize that higher rate of interest by rolling into futures contracts at lower and lower rates. Of course, you will be exposed to all the risk of the devaluation of the currency, and that's what you're getting paid for. What does this look like when you do it on your interactive broker screen? So here I've pulled up in an account. What is it like if I want to buy 1 contract of the Indian rupees futures? Now here we will see the notional amount of the contract on the lower left is 27,000 US dollars. I'm going to get charged a $1.71 commission to buy these 2 million rupees at a price of 135, which is what I've put as my limit order here. You'll notice that's below the bid and the ask on the screen, so I'm not going to get filled until the price falls to my limit price. You will also notice on the lower right, how does this impact my margin? I don't have to have $27,000 in my account in order to, or 27,000 liquid, cash, whatever, in order to buy this futures contract. This is only going to reduce my initial margin by $3,415. So very roughly back of the envelope, it looks like it's giving me about 8-to-1 leverage. Now, I never, ever, ever recommend pushing that by any stretch of the word. I wouldn't recommend doing this if you had anything less than, even $10,000, $15,000 in your account. You want to leave a lot of margin there so that if, March 2020 or, September 2008 happens, the rupee crashes, you don't get margin called and you don't get wiped out. But this is what it's going to look like if you type in IU and you go click a buy order for one of these futures contracts. If we instead look at the Chinese Yuan Renminbi at CNH, now what's called CNH, it's offshore Renminbi. This is a deliverable futures contract for Renminbi that are going to be delivered traditionally in Hong Kong. Now there's offshore Renminbi deposits in a lot of places. You can open a DBS Singapore account. I think they'll hold Renminbi for you. So that's why you'll notice that this will be settled in Renminbi in your Interactive Brokers account. And the notional value here is 100,000 US dollars. So right now, if I wanted to sell one contract, I would be selling basically 100,000 US dollars at a price of 650,000 renminbi for that 100,000 US dollars. I would be paying a commission of 10.55 RMB, which is a little less than 2 US dollars. So, total net amount there. And you'll see the margin impact on the right. There's actually not a lot of margin required for this one, in part because the renminbi is a lot less volatile as a currency than the Indian rupee. And once again, whether you buy or sell this future could reflect your views on whether the renminbi is going to go up or down, or maybe you've bought a renminbi bond and you want to hedge it. These are all different things all different strategies you could use this for. For the Korean won futures really look kind of similar to the Indian rupee ones. It's quoted inversely to what you'd usually see. So in other words, this is what is the price of I think in this case, 10,000 Korean won or 1,000 Korean won in US dollars. So what this says is 1,000 Korean won will cost you about 89.64 US cents. One contract is going to be around 22,000 US dollars plus your $1.71 commission. You can see on the lower left, you only need to put down about 5% for margin. Once again, don't go anywhere near that. Please have a lot more cash in your account if you were going to trade futures contracts. But this is one way of basically buying exposure to the Korean won, or if you want to do the opposite, hedging out exposure to the Korean won. Finally, in the examples, I wanted to show what the Taiwan Dollar futures contract looks like. I didn't show it on my screen earlier, but you would get this by typing in TWD. This is basically a full-sized US dollar futures contract. And if I understand correctly, this is a Quanto. I haven't traded this because, again, I'm more interested in renminbi than I am in Taiwan dollar. But if you want to look at what the contract looks like, type in TWD on your Interactive Broker screen, and you will see a contract order and margin impact size somewhat like this. Singapore dollars, so sorry, not Taiwan dollars last, it was Singapore dollars that was last. This one I do use because I do have Singapore dollar positions in my accounts. I do actually have client positions that have Singapore dollars in them. This is if you want to buy US dollars, you're buying US dollars and you're buying it for an amount of Singapore dollars. Here I say I want to sell at a limit price of 135. Contract size here is about 33,750 Singapore dollars. I think that's around 25,000 US dollars. Commission there is $2.90 Sing. Very, very little margin impact there. Again, Sing dollars are relatively stable currency. So ticker there is US if you want to go ahead and pull that up on your future screen in Interactive Brokers. As far as actionable strategies, there are a few I mentioned. The first one, as I mentioned with the Indian rupee, is a carry trade. What is a carry trade? A carry trade is basically where you're getting out of a low interest rate currency and trying to earn interest in a higher yielding currency. So in the case of the Indian rupee, is you buy, say the April Indian rupee futures contracts at a lower price than the March futures because you want to earn that higher Indian interest rate. And basically, if the Indian rupee doesn't go anywhere, or even if it appreciates, you're going to earn a higher rate of return than you would just keeping your money in dollars. Now, generally, as I said with the Indonesian Rupia, this is a risk-on trade. The people willing to go chase a currency with a higher interest rate do so when they feel it's safe. And everybody is going to do it when they feel fine putting their money into stocks and high-yielding bonds and other high-yielding assets. And then when the market panics, these things tend to do poorly. So go chase these yields knowing full well what types of risks you're taking and what types of risks you're getting paid for. The reason that you would want to do this with futures is that you are going to get institutional pricing in a way that you probably won't if you just have an Indian bank account and get a retail bank deposit or so on like that. The same is true with any of the other hedging strategies we discussed. If you go to your bank and you try to get like a regular hedging product, you're probably not going to get pricing that is quite as good as you will get on a futures exchange, which would be used by institutions. So better than retail margin rates. That's why you'd want to use it for carry trades. What about for momentum trades? What's a momentum trade? Well, a momentum trade is something different than what I do, but I used to look at momentum strategies many years ago. This is basically where you look at something that's going up and you buy it. And when you see something that's going down, you sell it. You might have your own system for this. Maybe you'll use moving average crossovers. Maybe you'll look at, 12-month, trend indicators. You might have trend indicators of all the different currencies and buy whichever one's going up, sell whichever one is going down. This is certainly a much more active strategy. And if you like to program Interactive Brokers API, it's probably something you could automate if you want to put your rules into it. But it requires you to pay the bid offer spread rather than collect the bid offer spread. The example I showed you for the Indian rupee, I wanted to wait until it got down to 135 before I bought it. If I wanted to follow momentum, it means as it's going up, I'm going to actually want to just go ahead and hit the offer price and pay that. And then when it flips around, I'm going to be paying the bid offer as well to get to the other side. So if the trend is your friend, you can make money in momentum, but just know the risks and the costs when you go into it. Strategy number 3 is specific hedging. So specific hedging is if you've actually got, let's say, an asset in one of these currencies. Let's say, for example, you worked in India for many years and maybe you have an Indian pension and you were watching this and you saw, oh my gosh, yeah, you're right. I'm worried about depreciation, that my Indian pension is going to be worth less and less year after year as the rupee gets devalued. Well, you can use these futures contracts to lock in the exchange rate of the Indian rupee against the US dollar. In this case, you have a specific asset. It could be a pension, it could be a foreign bond, it could be a house, it could be, whatever you might have in a foreign currency. You have the notional amount, and you simply trade the number of futures it takes to effectively lock in an interest rate. What this means is you don't have to have that amount, on hand. You don't have to have the dollars on hand. You are locking in an interest rate in the future. And if the exchange rate moves against you, the futures contract will pay you. If the exchange rate moves in your favor, you're going to lose money on the futures contract, but that's exactly the same in the amount that it's going to benefit you on the other side. So let's say you hedge your Indian pension, and then the rupee continues to strengthen. You're going to lose money on the futures contract, but that means your pension is going to be more valuable when you convert it into dollars. So I gave you another example here, which is if you've got a US dollar high yielding bond, but you want your investments in renminbi, you can buy a $100,000 US high yielding bond, and then you can sell the CNH futures to basically convert the dollar bond into renminbi. So whether you collect or pay the rate differential depends on which way you're going. Last but not least is a form of macro hedging. So this is really not a true hedge, it's more of a risk position, where let's say, for example, you've got an overall portfolio and you're worried about a decline in the US dollar. Well, I mentioned I like the Singapore dollar as a hedge against an overall decline in the US dollar. So if you sell the Sing dollar futures, that's a simple way of doing that trade, if that's what you so please. Remember, the Sing dollar futures is the price of a US dollar in Singapore dollars. So if you sell a contract, that exchange rate goes down, it means the Singapore dollar is strengthening, the US dollar is weakening. So that is it for my presentation today. Here are my contact details, my WeChat QR code, my email address, and my website, and my phone number if you'd like to reach me on WhatsApp, WeChat, as you wish. At this point, I would like to open for questions. and see if any of you would like to ask me about some of the many Asian currency topics we talked about today. You can go ahead and ask your questions in the question panel. I remembered actually this was one of the tests that Cynthia used to do earlier, where she would say, if you can go over to questions and type Y or yes or hi there to test it out. And I noticed that we didn't do it here. So something to keep in mind for future webinars.
Hi, Tariq. There are several questions there. Can you see them?
No, I do not.
Oh, hold on 1 second. Okay, 1 second. Now you should be able to see them in your GoToWebinar panel.
Now you see it. All right. Wow, you're right. There are a lot of questions. So let me see if I can do this. All right. First question. The Federal Reserve cannot let interest rates run too hot without it adversely affecting government debt levels, and it appears the U.S. dollar is a phase of structural decline. Past U.S. allies have now the largest debt holder is China. What happens when the U.S. government devalues the debt in real terms from a geopolitical perspective? Oh, wow. Is that not the $16,000 question? You've probably heard the old term, if you lend someone $1 million, they have a problem. If you lend someone $1 trillion, you have a problem. Or the other way you sometimes say it, you lend someone $1 million, you have a creditor. If you lend someone $1 trillion, you have a partner. The fact is that when Japan and China have bought this much in U.S. reserves, they in a way have become joint at the hip. And so yes, there is a lot of geopolitical question and U.S.-China relations that comes into what that debt and what the value of the dollar is. But I think it's almost largely accepted that the dollar, the U.S. would have to devalue its way out of its debt over time, in one way or another, and that everyone who holds it is kind of going to be in the boat with it. Remember that central banks are not profit maximizing. Their goal is not to maximize total returns for shareholders in some base currency. Their goal ultimately is to stabilize their own economies. So to the extent that, say, a devaluing U.S. currency upsets the U.S.-China trade balance, we could see a flare-up of the U.S.-China trade war like we saw with Trump. Now, we may not have Trump at the helm to deal with that, but that will be another question as well. So great question on the geopolitical side. What does the Japanese population pyramid look like? It looks horrible. It looks a lot like Korea's population pyramid. Japan has the oldest population in the world by median age. I think it's around 48, 49 right now, and a dire shortage of children, and of course not a lot of immigration. So you could use Korea's roughly as a proxy, but populationpyramid.net will give you the current pyramid. What will be the future of the Hong Kong dollar? Will it vanish and be absorbed into the CNY, CNH? If so, approximately when? Excellent question. I've been asked this for about the past 20, 25 years. Short answer is nobody knows. I mean, the Hong Kong dollar has been pegged to the US dollar since 1983. In 1997, people thought the Hong Kong dollar was going to crash or go away. And then again in 2005, when the renminbi started to float, they thought it was going to crash and go away. And then when I came here in 2011 and we started having CNH in Hong Kong, people thought, okay, that was the end. It was going to go away. Who knows? It's ultimately up to the HKMA. Some people say it's tied to the one country, two systems thing. I don't really think it is. My armchair view is the Hong Kong dollar is really China's kind of second currency that it can use to have the best of both worlds. Because if you think about it, with the Hong Kong dollar, it has a fully freely convertible currency. It can almost use like a US dollar in disguise that everyone has full confidence in, and you can come and buy shares in Hong Kong and Hong Kong dollars and not worry about any of the things that are associated with the renminbi. And on the other hand, it can also have a currency like the renminbi with very metered currency controls like you've seen with CNH and with Stock Connect and so on. So if I were Beijing, I'd want to keep them both because you get the best of both worlds. You can probably think of other countries that have had that as well. But of course, nothing great lasts forever. And, we all talk about one country, two systems ending in 2047. So 2047 is maybe a good over under you want to put in saying, will the Hong Kong dollar, be absorbed by the renminbi before and after that? Who knows? Which website gives you good macroeconomic data allowing you to make actionable FX futures trade? Oh my. Well, there are so many, really depending on which economic data you find most useful. I mentioned Asia bonds online because I think a good starting point for all these currencies is to look at what their relative interest rates are. Another one would be Google public data, so you could, or let's say the IMF World Economic Outlook, to look at relative inflation rates in each of these different economies. You can, of course, also go to the central banks, the websites of each of the central banks of each of these countries as well. Lots and lots of data out there, really depending on how you want to do your macro analysis. Thanks for that question. Does China have any strategic view or strategic say over Taiwanese monetary policy? Oh dear. I don't think I really want to tread on that question, but as you probably know, there are different central banks between the People's Bank of China and what is called the Central Bank of China, based in Taipei. I will leave that question to someone else who feels who knows more about that than I do, because I have to admit I don't pay that much attention to it. I've got a bunch of other things that I think are better. Why was the ringgit? Why was the Malaysian ringgit a proxy for the Chinese renminbi? Great question. I don't really know why, but I know for a period of time traders thought that it was. The main reason I believe, if I were to speculate on it, was that both were tightly controlled currencies by their own central banks. And Malaysia was really managing its partnership with China as its most important trading relationship. At the time, Malaysia was largely a resources exporter and China was a resource importer. So relative stability between the ringgit and the renminbi was, I think, considered advantageous. Now, of course, the commodities boom of the 2000s, crashed along with the global financial crisis and really the death knell in 2014. So that's why I don't think it's quite as relevant now as it was in the 2000s. Next, what are the controls around moving cap gains denominated in an RMB from my IBKR account in the US to, say, my bank account in Singapore? Well, great question. Overall, I have not seen any limitations or controls. Let's say, for example, if you buy renminbi-denominated stocks via Stock Connect, let's say you buy Chinese A shares on Northbound Stock Connect, you sell them, you realize capital gains, you convert the renminbi to US dollars or to Singapore dollars. I have not felt any friction or any limits in doing that. Now, technically, there used to be a daily quota. That quota has since been lifted. At any time, they could close the gates or they could impose new quotas. But so far, for all practical purposes, most of us with IBKR accounts will not see any of those limits with regards to Stock Connect. Now, if you're talking about QFII or QDII quotas, separate matters. Within your IBKR accounts, pretty easy. Next, are there any of these equivalents or more liquid formats, for example, sold on the CME? The main one I know on the CME is, of course, on the yen. I haven't looked at a lot of these other currencies other than the yen and, of course, the renminbi on the CME. So short answer is yes, let's go look on the CME and compare and trade whichever one's more liquid. They can all be traded on the on your Interactive Brokers account. This one really I wanted to highlight with Asian currencies, and the Korean won and Indian rupee are the ones, of course, that I mostly trade in Singapore. I haven't checked if they are on CME as well. Are options available on any of these futures contracts to tailor risk to a different scenario? If so, I haven't found them yet. It would be great if they were. But thanks for that question. I do want to do one of my future webinars on options. I mostly trade options on equities and ETFs, not currencies, at least for now. So that's why. Is there a Malaysian ringgit futures contract? I believe on the screenshot I showed there was one, but I haven't been able to pull it up in Interactive Brokers and I haven't been able to trade it. So yep, if we ever find one, that would be great, but haven't seen one so far. Next question, what should be a strategy in the current market situation, specifically possible high yields, increasing inflation in US dollars, and high interest rates and impacts on US stocks? Well, the short answer is with those things, I tend to not like, currencies and bonds. I mean, in general, if you think about it, inflation, as I've shown with all these examples, inflation is the enemy of a currency. When a currency has inflation, you want to get out of that currency. When a currency has deflation, like the yen, you want to get in that currency. But in general, if you've got a currency with inflation, you want to own, pro-cyclical assets in that currency. Right now in US dollars, I am looking for stocks, I'm looking for companies that have a lot of US dollar debt, especially long-term US dollar debt with low interest rates, because they're going to be able to pay those back in cheaper dollars when the dollar gets inflated away, and the values of those stocks will appreciate and they'll be able to pay higher dividends over time. that's my multi-asset approach. I'm not sure if that gave you a good answer from a currency question, but thank you for asking that. What types of risk if we invest in Pakistani Rupee due to the high interest rate for the next 6 months using the US dollar versus the Canadian dollar? Well, unfortunately, I haven't found an easy way of trading the Pakistani Rupee. I don't think that SGX has futures contracts on it, even though I think it would be kind of neat to have it as an option. The Pakistani Rupee actually in many ways can look like, say, the Indian Rupee or the Indonesian Rupia. It's an EM currency, which every now and then has periods of stability, but then every now and then, has declined, up past 100 and different levels. Because it's so hard to trade, I haven't followed it so closely, but I remember there was one year where the Pakistani Rupee was like one of the strongest performing currencies, and I think more than anything, that was a fluke. With any of these, if you chase high yields, you could have periods where, you could earn maybe 5 to 8% in 1 year, but you could also have a year where you lose 20%. The risks are pretty easy to measure, pretty clear. The problem is you just don't know when it's going to happen to you. What currency is to keep nowadays between the Canadian dollar and the US dollar? Short answer is if it's not money that you need within the next 6 months to 2 years, you probably don't want to keep it in cash. That's the Ray Dalio statement that cash is trash. What he means by that is central banks are really trying to to inflate away the value of your currency. And, maybe the Bank of Canada is being a little bit nicer than the US Federal Reserve, but right now, if you don't need to spend that money in the near term, you probably want to find alternatives to cash that are going to protect you if they get inflated away. I mentioned, for example, I do use the Singapore dollar as a broad proxy against dollar devaluation, but that's not going to be perfect as well. In addition to MTIP, is it worth watching the Vietnamese dong? I'd love to, but we can't really trade it. The Vietnamese dong is a really, really tough and tricky currency. And, we can't trade Vietnamese stocks in our interactive brokers account because it's an ID market. You have to go there and get a local custodian and, get your own ID and get approval every time you trade shares and clear it with your custodian. It's a really, really tricky currency. So maybe keep it on your dashboard and see how the Vietnamese economy is doing. But, I'm waiting for the day that I can, trade the dong and trade shares in my interactive brokers account. What would be the future of the Pakistani Rupee and the Canadian dollar? Really, who knows? The Pakistani Rupee is, of course, a bit of a wild card because it has a lot to do with how the economy does, and it also has a lot to do with how the central bank wants to manage the economy. Pakistan was recently upgraded from a frontier market to an emerging market, but it still is like, I think, a single B-rated country from a credit point of view, and has gotten into trouble with the IMF. So we'll have to really look at how the IMF resolves Pakistan's situation. The Canadian dollar, as you saw, was at parity with the US dollar many, many years ago, and it weakened to around 140, and it's now strengthened to around 125. The Canadian dollar has a lot to do with minerals and oil, but it's also kind of an offset against the US dollar. It's a relatively stable currency, but the Canadian dollar will fall if oil prices fall. If oil prices, if inflation means stronger oil prices, stronger mineral prices, that will be bullish on the Canadian dollar. So very, very broad highlights there, but hope it gave you a good idea there. Thank you for the excellent responses. Well, thank you all for attending. I believe I've reached the end of my questions there. You've got my contact details there, and I hope I'll be able to get your contact details and send you a follow-up email within the next day or two, and hopefully see you on my next webinar. Thank you very much for hosting Andrew and Guillaume as well. I'll look forward to our next event as well.
Tariq, thank you very much. An excellent presentation as ever. It's fantastic to meet you online. It's about school time here, so I've got to go and get the kids out of bed now.
And I've got to catch my ferry. I'll run now. Talk later. Bye.
All right. Bye then.